Yeah, Salesforce. Let's take a look at Salesforce. This might be a better example. So Fernando says, the implied volatility in an option, example 30%, means that the market maker forecasts a 30% of underlying movement before the option expiring. No, that is not what it's implying at all. More along the lines, remember what implied volatility is, Fernando. The stock itself has the volatility. Whether you calculate it by the 20-day, 50-day, 100-day, how much has the stock fluctuated, changed in price? And it doesn't mean it's changed 40% or 47%, but based on the price and everything, how much has it fluctuated in those last time periods? Let's just focus on the 50-day at 40%. This doesn't mean the stock has moved 40% in the last 50 days. That's not what it's implying at all. We're talking about the stock volatility. Now let's go back to our search. Not that search. Let's go back to the bull put credit spread for CRM. Let's take a look at the research, the short put. Okay. Oh, this one dipped hard, didn't it? Okay, but that's okay. So we saw that our 50-day volatility on the underlying security itself was around 0.40. The implied volatility of this option, let's just call it around 0.45. Let's get the actual number here. Doobie, 0.4544. Has an IV/HV ratio of 1.1. The implied volatility of the option itself is 10% higher than the 50-day volatility of the stock, is essentially what we're looking at here. SIV was on the other page, the stock research page. That's the average implied volatility across all in the money and out of the money options as well. And as you can see here, over the life of the option, it's only moved from 0.40 to 0.5422. So we're only at the 38th percentile of the total implied volatility. This is not saying that we're expecting a 45% movement in the underlying. It's not even saying that you're expecting a 45% movement in one direction or the other of the option price. My option premium I paid or the option premium I collected. It's not saying that either. It's saying that in general, the market, the implied volatility of the options, the market is implying a 5% perhaps plus or minus movement over what normal volatility would be. That's all it's implying. And that doesn't mean 5% in the underlying. It's more related to 5% more than the movement of how a change in volatility would affect the change in the stock price, increase or decrease. I know that's confusing. There's no real exact equation for it. What we need to remember here, let me just redraw that out here, is 0.40 and 0.45. Okay, this is the IV. This is the historical volatility or stock volatility. Now remember, when to calculate the price of an option, the theoretical Black-Scholes pricing model, what do you need? You need the 5 factors. Stock price, we use $. The strike price of the option. I'm looking at $173 stock. I'm looking at 160 put. It's going to be different, inherent or not necessarily intrinsic, but related to the ATM bell curve. And if it's out of the money, if I'm only 1 strike out of the money, it's going to be a higher price than 10 strikes out of the money, that kind of thing. So the stock price, strike price of the option, days remaining to expiration. Naturally, of course, a 75-day out option, Fernando, is going to have a higher price than a 30-day out option. The current free interest rate or current interest rate across the market, which has been in flux recently. So the current interest, I'll say %INT for you. And then what? The stock volatility. How much does the stock tend to fluctuate? That's going to account into the expected theoretical option price. Okay, this is the Black-Scholes pricing model. These 5 factors are plugged into an equation, and it spits out a value of where our options should be priced based on these metrics. Okay, How is implied volatility derived? Okay, so here's my option theoretical price. Well, if the theoretical Black-Scholes value tells me that the option should be trading at $4.80, but the actual midpoint bid price or midpoint or ask price is really $5.10, that means it's trading above its expected value. How much above? Well, now what we do is we put 5.10. What is the only variable here? Well, there's a couple of different variables, but other than the stock price and the strike price, what is the only variable that's in flux? It's the stock volatility, right? But let's solve it backwards. What do? We put in 5.10 as the answer, work the equation backwards, take out the volatility, and solve for what volatility equals why this option is priced 30 cents higher than its theoretical value should be based on the Black-Scholes pricing model. That answer is your implied volatility. It's not saying by any means that the market maker is forecasting 30%, well, yeah, okay, 30% of the expected underlying movement. It's not like that. You got to compare it to the historical volatility. What I mean by that is that if I know that 0.4 volatility is telling me that on average over a 10 or 15-day period, a stock with a 40-day volatility might move up 4 or 5 points, the implied volatility is telling me the market maker is saying it might move up 450 to 475, up or down. It's not up. It's not saying it's moving up. It's not saying it's moving down if it's above or below, if it's undervalued or overvalued. That's more along the lines of what it's saying, Fernando. Okay? You might have been trying to say that, I think, when you said the market maker forecasts a 30% underlying movement before the option expiring. It's more along the lines of what is it above the 50-day moving average? I'm sorry. What is it above the 20-day or 50-day volatility? Here you see we're at a 8 or 9% increase. So it's probably saying that the market maker is expecting in this case a movement of maybe 8 or 9% up or down compared to what the movement would be of a normal stock with a stock volatility of 0.40 moving over the next 10, 15, 20 days to expiration. Does that make sense? It was kind of a weird explanation, but that's how I look at it. It's not saying that the stock's going to move up 30 to 45% or down. It's not saying that you're making 30 to 45% of what you'd expect to make with a stock in a normal volatility of 40 for a 50-day volatility, where you'd expect maybe to move $2 or $3. It's saying maybe you're expecting 10% more than that $2 or $3 movement because the implied volatility was at 0.45, 10, 11% above what it is right now, that 1.1, 1.2%. That's how I understand it, Fernando. That's how I look at it when I see those numbers. And when you see a high implied volatility ratio, a high IV over HV, absolutely, you're going to be getting more bang for the buck. If I have implied volatility ratio of 1.27, well, that's not actually that high, but let's say 1.75 or 2.1, where the implied volatility is almost double the stock volatility, that's more pointing to an expectation that the stock could fluctuate twice as much as you'd expect with the regular volatility, a movement twice as much as you'd expect with a regular volatility of whatever value the stock was due to some event coming up, which now you've got to pick your poison. Selling into it means you're getting a great premium, more than you'd probably get in any comparable stock with the same price, same strike price, same days to expiration, and same interest rate across the market. But it has that higher implied volatility or reason. News is in the background. Some event is coming up. Could be earnings, could be FDA approval, could be the concern. The implied volatility on SIVB options was extremely high leading up to this because there were certain tests that were being done. They met with, Yellen met with them when? Last week, I think. There are things of that nature. I saw articles today about Gap is essentially, someone wrote an article saying Gap is just essentially giving up that they're not buying new inventory at all. They're just burning through old inventory at cheap, discounted rates, and they're not bringing in more product. They closed the position of what was it called, a CGO, which was the corporate officer for growth and acceleration of the company, and then they got rid of their CEO that they had in name for personal development, people development, working inside the company and looking for aggressive paths forward to grow the company brand. They've cut all that down. And let me just see. Let's go to the chain. I don't even know if we can see the chain. Okay. Well, let's try Gap. JCPenney is another one we've seen recently with, oh, darn. I thought Gap had options. I apologize. Is Gap brand? It's not GPS, is it? It is GPS. I'm sorry. That would solve the problem. Let's see. Oh, now this isn't as bad as I thought. Let's go out 14 days. Yeah, so this is at 0.54. So that's not too far out of bounds, but for the stock itself, the volatility is probably equal to that. I'm just trying to, well, maybe we'll have to do a search to take a look at this. Yeah, okay, so it's 0.40. That is a pretty good, it's about where we were before, but this is now almost like a 1.25, 1.3% IV over HV ratio. Again, that doesn't mean the stock's going up, right? That means that the market maker is maybe expecting a 25% more movement on GPS, in this case in the next 14 days, than what would be implied on a regular stock with a 0.4% volatility in normal market conditions. So that means, again, $2 or $3, maybe the implied volatility might be saying he's expecting, market maker, excuse me, he or she, or the computer is expecting a 20 to 25% movement above that $2 or $3 in that case, due to some event that's coming up, news that just came out. They just had earnings, so that's why things are still in flux. So they drop. I mean, this is a big drop because it's a low price stock, but did they take a huge hit the other day? Pretty huge. Yeah, okay, so yeah, lost about 20% from 12. Yeah, we're down about, this one's down about 30% almost from where it was a month ago. A little bit more than that, actually. Wow, down 50% from where it was that February, beginning of February? Yeah. So at this point, leading up to the earnings, the IV was probably pretty high as well. Okay. Yeah, so you said, yeah, so measure the difference from the Black-Scholes calculation. Yeah, that's how the IV is essentially derived, but compare the IV to the historical volatility. Usually the 50-day is a good measure. But yeah, if you're looking at 14-day out options or 7-day out options, you might want to compare your IV to the 20-day volatility that we saw there on the stock detail page. Yeah, see the SIV here, the average of all the in the money and out of the money near-term calls and puts is 0.5254, kind of what we saw in the chain. 20-day volatility is only at 0.33, the 50 days at 0.40. So that is a big swing. So they're expecting more movement than the average, even in the shorter term, because of this negative news that's coming out, the negative earnings. They lost in, I can't remember the exact numbers, but they lost in all 4 segments of their income streams. Not a good look. And then there's the discussion of how they're not buying inventory anymore. They're emptying their warehouses and putting most of that inventory on clearance prices or 50% discount prices. They're not trying to build new brands. They're not trying to buy into new brands. They can't move Old Navy products anymore. Anyway, I'm not saying buy puts on Gap by any stretch of the imagination. It's just an article I read. And it's just, he said, it was funny the way the writer put it. It says Gap has just decided they're no longer relevant and they've given up. And I said, you can't just write something about that. No company ever gives up. And I started reading the details. I'm like, oh, okay, maybe there's a rationale to this writer's title, and it's not too far off base from what we're seeing here. But again, nothing against Gap, no recommendation to buy, sell, trade options against it, just for our discussion. That's what we're kind of looking at. That's my impression of what we're looking at with implied volatility. It's the volatility that implies why the current option price is not equal to the theoretical value, which is based on the recent stock movement of the last 20 days, 50 days, as I explained, as we talked about, Fernando. And so to me, that's telling me, hey, if I have an implied volatility ratio of 1.2, meaning the implied volatility of my option is 20% higher than the, oh shoot, I just got rid of that. It's 20% higher, for example, than the Here we go. Let's just go there. Sorry about that. This one was a different one. Yeah, 1.3. So it's 30% higher. This is a different option we were looking at. The implied volatility here at 0.5361 is 30% higher than that 20-day, 50-day volatility. I'm pretty sure it's the 50-day volatility. So if in normal conditions, the stock volatility of 0.38 implies that the stock would move $2 or $3 in the next 14 days, this is saying it might move 30% higher, it might move up 260 or 270 up or down beyond what it would move with the standard volatility movement, normal market conditions. Just like everything else, our delta, our gamma, our theta, of course, we know the implied volatility and the IV ratios are always going to be in flux. It's harder to change the 20-day or 50-day volatility of the underlying security without a giant move. And GPS has definitely seen some giant moves in the past 20 and 50 days, as we just saw. There it is again. So maybe not all of them sudden, but definitely some, at least 4 or 5 good sudden movements that just erupted downward.